Welcome to the Seattle Investors Club podcast with Julie Clark and Joe Bauer, where we share the nuts and bolts of real estate investing from our 20-plus years in the industry. Sit back, relax, listen, and immediately take action. Are you ready? Here we go.
Welcome to the Seattle Investors Club podcast, where we talk about the nuts and bolts of real estate investing. My name is Joe Bauer, and I'm here with my co-host, Julie Clark. Julie, how are you doing today?
I'm good, but you're not actually here with me, Joe, are you?
Oh my gosh, I am not. But it sounds like we're in the same room, I think.
It does.
Yep.
It does, but we're not. We never are. That's the secret sauce. We're always thousands of miles apart, at least for the last 3 or 4 months here. Or how long has it been now?
How long
has it been since you left me, dear?
It has been almost exactly 2 months and 6 days.
Oh my God.
And
like 4 months.
12 hours maybe.
Yeah, I feel that. Yes. I think all of you know Joe's on the road. And he is living the dream in his fantastic life. I'll let you say a little blurb on that. And then I want to tell you guys a little funny thing that I've been watching lately.
Oh, I'm excited to hear the funny thing. Okay, I'll make this quick. So if you guys want to follow my crazy van adventures, it's at thefantasticlife.com or The Fantastic Life on Instagram or Facebook. Right now, I'm actually in West Yellowstone. And funny story, we do a lot of trail running. My girlfriend and I love trail running. We can see things faster. We can get exercise, all that fun stuff. And we went to the ranger station just earlier today and asked them about good trails in Yellowstone because we didn't see many on the map. Like the longest one was 8 miles. And we're usually trying to get deeper into the parks so that we can get out of the crowds. What the ranger said is, we do not recommend trail running off of the boardwalks because of the grizzly bears.
Ooh.
Yeah, so we will not be trail running in Yellowstone National Park, unfortunately.
God, do you guys carry weapons or bear spray or?
We plan on carrying bear spray once we get out of into the less populated parks. Kind of like a quick draw bear spray system.
You know what I'm always afraid of? That's like pepper spray and all that stuff that you would, like real estate agents would take into a house. Yeah. I'm always terrified I'm just going to spray it in my own face. That's my
totally. And I think
fear.
that people probably spray it in their own face more than they spray bears, I would guess.
Well, please be careful.
I will be careful, but I want to hear your story. Let's hear your story.
Well, I don't really have a story, but the girls, I have twin girls. Most of you guys know that by now. And it's summer, so we've been binge watching. We just got done with Stranger Things, which has resulted in Mark, who's on the line with us, might know about this too. But we just bought our first Dungeons and Dragons set. Isn't it? You guys know what that is? It's like a fantasy. I don't even know how to describe it. Demagogues. And anyways, that's not what I was going to say. But we wrapped up Stranger Things. And we had to look for something else to watch as our little bonding kind of rest time together at night because I'm so busy all the time. It's a nice time to just circle up and relax. And I ran into this thing called Comedians in Cars Getting Coffee.
Oh.
It is freaking hilarious. And it's like the one I just saw was Jerry Seinfeld with President Obama. And they're just kicking around like two guys talking shop. And anyways, it's hilarious. Comedians in Cars Getting Coffee. It actually inspired me to do some sort of, how they have that guy, James Corrigan or whatever he does the karaoke in the cars. Now you got this comedian in cars thing that's hilarious. I'm going to kick off my own real estate, something to do with real estate in cars. I don't know what it's going to be, but they're always, whatever the car stuff is, other than just the videos of giving advice from the car is kind of boring. But I'm going to come up with something, and I'm going to let you guys know what that is.
That's what we totally should have pitched to the studios that wanted to have the flipping house people. We should have been like, well, we could do real estate in cars. Right. It's actually better than your idea.
Right, because all those ideas are boring. I told you that some filmmaker just called me. I mean, once you start doing these podcasts and stuff, guys, you get all this stuff coming out of the woodwork, all these. So some filmmaker who feels like they have a bond with me or something like that because they listen to the podcast has contacted me. I think it's just a scheme to get me to invest in their whatever their movie is, but we'll see what that is. I haven't called them back yet. But speaking of hobbies and stuff that has absolutely nothing to do with real estate, let's welcome our friend Mark in here and ask him a bunch of random questions to kick this off.
Heck yeah.
Hello.
Hey, Mark, how you doing?
Good.
Thanks
Right
for
on.
coming on the show today. Where are you right now, Mark?
I am in a car, so you can say we're doing real estate in a car, but I'm in a car that's on a boat. I am on a ferry right now near
Nice.
Vashon.
Awesome.
What are you doing over there?
I am headed across the pond for a little bit.
Nice. Well, it's a good day for it. I haven't been on a car ferry in a while. I need to do that soon. So speaking of nothing to do with real estate, Mark, what do you do outside of work and investing and riding car ferries? What do you like to do?
I'm really into boating. I had a sailboat for about 7 years. I sold that. Now I have a little motorboat, but it's really a joke. It's inflatable. It has a little outboard engine. I like to take that out, get on the water, get around nature, meet good people. I also do a fair amount of charitable work that keeps me busy, and I'm always hunting for the next property. So those three things tend to take up most of the evenings and weekends. Of course, I like to travel like everybody else as well.
Yeah. What's your favorite travel spot that you've been to?
Yeah, that's a tough question. I like to change it up a lot. There are some people that like to go back to the same cabin or the same beach or the same town. I really like to change it up. I've been to Europe a few times. I've been to Brazil. I've been to Mexico a whole bunch of times. And actually, the last 3 years, I decided to try to get through a lot of America. As I'd been to Europe a couple times before I'd even been to the East Coast. And I said, well, that's kind of silly. So a year or two ago, I actually did a cross-country road trip from basically Atlanta to Seattle, and that was a lot of fun.
Nice.
Very cool. Very cool.
Are you a fisherman out in your boat, or you just tooling around out there?
No, I mean, I've gone fishing from time to time, but I just like to go out, relax, soak up some vitamin D, and enjoy the outdoors.
I hear that, boy. Where has our vitamin D gone right now? It's a little overcast here in Seattle, which I guess is a welcome break, but here we are at work on I don't even know what day of the week it is. It's a Thursday, normal podcast day. And so Mark, we forgot to introduce, we know Mark, guys. Mark's hangs with us at Seattle Investors Club and some of our other local real estate investing clubs and part of our network and always contributing. Mark's always contributing awesome knowledge and information. And, we thought, hey, you know what? It's time to tap into this guy's brain. CPA by trade. Why don't you fill us in on what you are and how you're involved in real estate investing, and we'll try and narrow our path here a little.
Sure. So I'm really passionate about real estate. Personally, I pursue buy and hold. I try to be as passive as humanly possible, except for the search itself, which is a constant job, of course. So I don't do flips. I don't do big, ugly rehabs. There are a lot of people out there that can make a lot of money doing it. I just don't have the stomach for it. But for the people who do it, that's great. Then by day, as you mentioned, I'm a partner in a local CPA firm here in West Seattle. We focus pretty heavily on real estate, although that's not all that we do. So we probably do well over 300 real estate investors' tax returns every year. And that tends to work pretty well, kind of seeing both sides of it. And we do enough of it that, I have friends who are clients and so forth. And I kind of get to have a little bit of an ear to the ground. I feel pretty lucky that I get to see what's going on in people's lives. And beyond just some boasting that you might see when people are out and about, I get to see what the real results were, on paper.
Sure.
So that's kind of the fun part, although of course it's extremely confidential. And I really enjoy that. In fact,
involved in real estate investing? Did you get involved in real estate investing because, you started off being a CPA for real estate investors and you saw kind of how much they loved it and you got into it because they clued you in on how awesome it was? Or did you always know did that kind of rub off on you, or did you always have a love for the real estate?
I don't think that's what kicked it off, but it certainly accelerated it. And I've actually, believe it or not, through my career, I've tried to steer a little bit away from real estate. I know it's going to be kind of a shocker, but I kind of thought, well, I don't want my assets and my day job to be in the same industry, especially if it's cyclical. But I've never really been able to get too far away from it because, when you love something, you're passionate about it and you're glowing, people are just kind of attracted to you. And so I really do enjoy it. So actually earlier on, I was doing a lot more work with like big corporations, but real estate's always been there. And now I've just kind of decided to let it kind of run its course in that, I love the people that I get to work with. I really do enjoy it. Yeah, I don't meet that ultimate goal of, having my client base different than my asset base, but that's okay. I'm doing just fine.
I like the analogy of when you do something that you love, you're glowing and people are attracted to you. That's funny because that's exactly, I think, how we came to know you, is that you were glowing and you were contributing. We were like, hey, you started, being in my peripheral vision, and I just kept noticing you and your awesome knowledge and contributions, and here we are. So that's a great analogy. I hope I glow. Now I feel like I need to. I want to glow. Joe, you glow.
I think you like glow and then it combusts, Julie. You're a combustor or exploder.
I'm an exploder, but then I don't know if that's good. Is that good or not good?
It's above glowing. It's just crazy.
Right on. Well, that is because some people call me crazy. So maybe it all makes sense to me now. Right on. So let's jump into a little bit of the accounting and tax and investor stuff here.Maybe I'll kick us off with sort of some basic stuff for our listeners that may be in Seattle and maybe in Oregon. I think we've got a fair amount of people listening to us now from the Portland area. And if you are outside of the Pacific Northwest, welcome. By the way, Pacific Northwest rules, so come over and see us. But so let me kick it off. So Mark, basic question, how is income from flips taxed differently than income from like sales of buy and holds or rental income or that type of thing? Is there a definite difference for tax purposes on those types of assets and what you do with them?
Yeah, there's a huge difference. So, of course, I got to start by saying everybody's situation varies, but this is one of the areas that is a lot more distinct for 98% of people. So when you're flipping a property, and I'm going to try to keep this 30,000 foot level so I don't put people to sleep, it kind of starts to look and feel like a job, right? You're active in it, you're going to it every day. And so the IRS starts to look at it and tax it as if it was a job rather than a passive real estate activity. And so there's a couple of real downsides to that. First of all, they try to hit you with self-employment tax, which is something totally different from income tax, but it could be a lot of money. It is about 15% roughly, and then you get a deduction. So you're out the door at about 12% on the first 130 grand or so of income. And that's on top of your income tax. A very common thing that a lot of flippers do is set up an S corp which you could use to reduce, but not fully eliminate that self-employment tax. Usually if you're netting more than 50 or 60 grand, it starts to really make sense to go through the administrative costs and kind of the headaches of setting up and maintaining an S corp. But, again, kind of every situation is a bit different. Also with flips, as you know, well, hopefully they're short term, right? Hopefully you're within your timeline.
Yeah.
And so, when you're looking at capital gains and that kind of thing, you're basically looking at ordinary income or close to ordinary income rates instead of capital gains, which are much lower. And it's almost like you're buying and selling a product, which is kind of the analogy that I use sometimes to kind of bring it down to English here. And so it's really the worst for taxes, to be frank. And I don't like to let the tax tail wag the dog in a way. If you're great at flipping and you can make a ton of money at it, stick to it. Even though it's a higher tax rate, You don't want to get into something that you're not good at or not comfortable with just for the sake of a lower rate. So that's some of the differences. With buy and hold real estate, it's very different. There is no self-employment tax. Again, 99% of the time, you get to depreciate the asset, which can oftentimes be your biggest expense. And it's actually my favorite because it's a non-cash expense. So you get a tax break for an expense you didn't actually pay for. And that number always surprises people with how large it can get. Buy and hold investing has gotten a lot better since the recent Congress tax changes last December. Now there are things like bonus depreciation, which make it much more advantageous to do improvements on your property. It makes more complicated topics like cost segregation much more advantageous and applicable in a lot more situations. And there's a few things like that. So, I mean, if you were to choose one just based on taxes alone, there's a very distinct difference there, but I don't think that's the sole reason to choose your strategy. You got to see where you can make hay in the first place.
That's interesting. A very, very interesting topic that I am super hot on. Been talking to our mutual friend, Albert Bowie about, right? And, the whole buy and hold. And I think the only reason that people don't get into the buy and hold stuff from the start as new investors, or the reason why they start with the flips, is because that's what all these real estate gurus and all that stuff talk about. They talk about going into buy and hold and rental properties as a second tier to getting into real estate investing, like flipping houses is the easiest. You know what? And that's totally, totally wrong. You can learn to flip or you can learn to be a landlord. Either one can come before the other. Like you said, being a buy-hold operator is much more beneficial cash flow-wise, tax-wise, and all that stuff. I think people are looking for, like, they think that they're going to make that 30, 40 grand big hit. And what they don't realize, from the start, if they flip, I got to get that 30,000 or whatever in my pocket because, they think that's more beneficial to them than having $1,000 of cash flow a month on some rental if they're able to buy it. It's like, they're focused on a dollar amount rather than the big picture. And I think that's because they're not educated properly from the start. They're taught just to look at how to flip from the start, with the rest being an add-on later. And what I think is that number one thing people need to be taught from the start is where they fit in regards to their borrowing capacity, or how, where they can borrow money, how they can borrow money, even if you have no credit and that sort of thing. You can always probably borrow hard money, but aside from hard money, which is more expensive and still requires some down payment, if you have a day job and you're getting into this, you might very well be able to increase your borrowing capacity or handle your borrowing capacity where you could get started in buy and holds from the start, which is the truth of the matter. Is anybody who flips after a couple years of flipping and they realize it's just a glorified job, they all, can you guys hear that? There's a buzz going on.
I can hear you.
All those guys end up like, oh my God, why did I flip all those properties? I should have kept them, right? For taxes, for big picture planning. So I'm glad that you brought that topic up, that from a tax perspective, flipping is like the worst thing you get started in, right? And I think that I'd like to change the conversation to teach people from the beginning a different approach to get started, so they're not just staring, and learning about how to flip properties or house hack. House hack maybe is better actually than flipping, but that's a great conversation piece that involves some tax benefits as well. So thanks for bringing that up. What do you think about house hacking? Do you have any thoughts on that?
I think it's great for beginners, and I definitely didn't mean to knock flipping. I know a lot of people who make a whole lot of money doing it. Oh, okay. Well, fine then. For the record, it was Julie, not Mark, right?
Yeah.
No, I think that house hacking is great. I think that with flipping and house hacking, I think the other reason why a lot of new people turn towards it is because it requires much less capital up front. if you're house hacking, hopefully you can get an FHA or something like that with a really low down payment. It could be tax advantageous. You need a roof over your head anyways. I think it's good for people who are beginning. And, when you look at that trade-off to what you would pay in rent anyways, that can be kind of an added benefit. I think that, I enjoy it. I think that, I want to hear that people are doing that. Once you have a few properties, you don't get as favorable loans anymore. So you have to put the same down payment. And so then you kind of start to wonder, and it's also a lifestyle choice also. And, it's up to each person whether that's kind of a sacrifice they want to make or not, if it's not their ideal living situation.
Right. And my point on the flips, of course, I love flips. We've done plenty of flips. We're also, I own rental properties and apartment units and all that stuff too. Definitely have survived through every downturn because of it, of owning rental property. I'm just saying that from the beginning, I'd like people to be educated about their tax position and what lane they can be moving to, as well as understanding where they fit in the debt world. Because understanding where you fit in your borrowing and your debt, can open up so many more doors for you if you know what you're able to do, right? I don't know. So wasn't knocking flipping, but I'm saying that you guys might have so much more available to you from the start than you realize. And we just need to help you understand what I'm talking about a little bit more. But all right, so we know that flips get taxed heavily. Kind of, would that be at the ordinary income level of tax? Whatever your personal tax bracket is kind of what you're going to get nailed with there, in addition to so Mark, on the self-employment tax, let's say you have a day job and you flip, you do both. Okay. You still have the possibility of getting hit with the self-employment tax if that part of your business flipping earns a certain amount of money, or how does that work? Because it's called self-employment.
Yeah, unfortunately, it still kind of looks and feels like a day job. And again, this isn't a blanket statement. There are some circumstances, if you do, one flip a year, or if you are very, very passive with it, if you are a passive investor, or even better yet, you just loan money to a flipper, then it's a whole different ball game. So there's a number of things that go into it, and there is some slight gray area. And if you ask 100 CPAs, you'll find 2 very aggressive ones that might let you get away with it, but I don't think that makes it a right answer.
Right.
I'm not in the business of inviting people to get audited. So, right. So it's, it kind of is what it is. Far and wide, there are some instances where, let's say you fix it up, you move into it, you sell it a few years later, or that kind of thing. There's some other strategies like that you can use to lower your tax burden. But I like to tell people, and as you can probably tell, I try to look far beyond the tax numbers. I say, is this really a place where you want to live in, for a few years? Is it really worth the tax savings, or,
right,
taking a risk of whatever the market might do in a few years, and so forth? So what I like to start with is actually a lot more broad than whether to flip or to house hack or whatnot. You had a great point, which is what's your lending situation? What's your capital? Because that's obviously going to restrict you a whole lot. And I like to just ask, what are your goals? What are your big long-term goals? And that'll dictate it. I think that a tremendous amount of time is wasted in investing, looking at strategies before you've really identified those goals. So if you want to build capital versus cash flow, or maybe build capital first and trade into cash flowing assets later, what's your time horizon? How involved do you want to be? What's your gut level comfort for risk? And we all define risk differently. And I think that those tend to narrow down the question of what strategy to use much more than just what the best taxes are.
Good answer. Love it. That's why you're here, brother. We love that. Awesome stuff so far. I love it. Do you have clients that can you 1031? I guess this doesn't make any sense. You can't 1031 or something out of a flip, can you? Does that make any sense? I have no idea.
Well, it's gray. I'll kind of leave it at that. That's really gray. A lot of people want to do that, and it's more of a question of, can you change the character of what it is, so if it's a rental for a few years, becomes a little more likely. And I don't mean to be wishy-washy with my answers here, but I don't want to give an ultimate statement and have somebody go out and take action based on something they heard on the podcast.
Fair enough.
So the answer is no. However, there are some squirrely circumstances where if you are willing to make some of those sacrifices, like holding on to it, changing the nature of it, having it be a rental, moving into it for a while, it could help your case.
What bothers me about all that stuff is in general, I don't know if I'm old and lazy, maybe I'm both, right? Maybe my glow has exploded to not, come back, but I get tired of trying to game situations so hard. You know what I want? I just want to know the rules, and I want to know the rules to make my life easy, just because if I know the rules, then I can play by the rules, and I can plan by playing by the rules. Trying to game every situation and pull out every trick is so tiring to me. I have kids, I have family, I have friends, I want to do stuff, I want to sleep at night. And honestly, same thing goes with being a wholesaler and a real estate investor and an agent. I don't need to play a bunch of games and know every dark corner and gray area. I don't mind sticking my toes on the line, right? But that's an educated toes on the line, right? Not too far over. And so I kind of appreciate where you're coming from on that is, you probably find a way to do this or that, but you're going to be, turning left and right, then taking a circle and doing a jumping jack. And then, it's kind of stupid, right? I mean,
yeah,
I'm saying it like, I think I'm cranky today, you guys. I'm kind of, what's up, man? I got to tell you what, this changing shift in the real estate market is making me have to work a little harder, if you know what I mean. And so I think I'm cranky. I apologize, but I do love you guys. I want you to know that. This is all for your benefit. So, how about in general, no tricky wholesale or no flip 1031s, but, let's say 1031 exchanges is what we're talking about, guys. That's when you've owned a property, a rental property, let's say for a while, could be any type of property, as long as it's not your personal residence, right? And you exchange that when you go to sell it and you trade across or up, I think. We just had William Exeter on the podcast. I don't think it's come out yet, but that was a good one coming up for you guys, or it should be out by the time you're hearing this. So go back and listen to that. Major nuggets in there. But do you have a lot of your clients that are steady Eddie investors doing 1031s, not out of flips, but out of their rental properties? And do you recommend that? Obviously, it's a way to defer taxes.
Yeah, I say look at what the tax bite's going to be. I got a phone call from somebody a month or two ago, and their capital gains tax was going to be $5,000, and they wanted to do a 1031 to avoid the $5,000. And I said, well, the problem right now is that it's still a really strong seller's market, despite whatever's been happening the past month or two. And you're really rushed into getting a property. So what are the odds that you can find a quality property that you like? More likely than not, you're going to wind up with something you're not as happy with. Is that worth $5,000 to get into a junky property? Of course not. So, and that's an extreme example, but, it could be very valuable. And especially when you get to something like estate planning, they say like defer till you die. You just 1031 forever. And then when you pass away, there's a step up in basis so that your heirs inherit the property, and it might be subject to estate tax, but the point is you've created all this wealth without ever paying capital gains tax on it. So it can certainly help in a lot of situations, but sometimes there's a problem with the property where you just need out of it, and it's depending on the dollar amount of the tax. I would say be really careful about rushing into a property that might be subpar.
Exactly.
That's the thing that's happening in today's market, and everybody's got kind of the same challenge with it. So it could be very powerful, especially over time. But again, it's not the end all be all.
I have clients that we're actively looking for 1031 right now properties. And, really what I think people are doing these days, even though it's more expensive because you're almost forced to, is do a reverse exchange, because you almost have to find something to exchange into before you actually initiate the process on the other side. I mean, it's because that could be changing here though, as the market is shifting and adjusting a little bit, but something we'll keep you guys updated on. But in general, 1031 is great. I guess you, like anything, what we're talking about, you need to look at your global picture. Maybe you need your 50 grand or, maybe you need that money because you have other opportunities in your global picture to go, maybe you need the money for something. It's not paying taxes isn't a bad thing. Although I tell you, sometimes I feel like, I can get my bills paid, all my annual bills paid in the first, 5 months of the year or something like that, or 6 months of the year. And then I got to work another couple months to, and I have big bills, guys. And then I got to work another couple months just simply to now cover my tax bill associated with the fact that I made all that money. So then I'm working for a while to cover that, right? It's like a chasing your tail all the time, except, as you know, that's with ordinary income. When you're generating ordinary income, I've benefited for years and years and years of having massive cash flow off of apartment projects that had, as we were talking about, tax losses or taxes lower, like, so you can actually collect monthly cash flow without having it affect your tax bill at the time. And that all feels good until you go and sell it and you have to recapture that depreciation. So maybe why don't you tell people what depreciation recapture is so they understand that it's, while owning rental properties is awesome and you feel like you're on cloud nine where you're collecting your cash flow with your low tax bill, it does catch up with you in the form of depreciation capture at the end.
Yeah, so while you're owning or renting out a rental property, you're charging a ton of depreciation expense, which is great because you're getting this big tax break during all this time. And that's a subject in its own, of course, and there's certain limitations to it. But it's a great thing. And then what happens when you go to sell, and I don't know why more people aren't talking about this, there's this thing called depreciation recapture, which means that, if you're selling for $1 million and let's say the basis, which is the depreciated values at 700 grand, you have this $300,000 gain. Normally, hopefully you would get that to qualify for long-term capital gains. However, the IRS says, wait a second, your income rate was, let's say 32% or whatever it is. And you were getting a break at that 32% all these years because you were depreciating this asset. Now you want to pay the taxes on 15%? That's arbitrage, right? So what they said is that you have to pay a slightly higher rate, not for the whole gain, but only for the depreciation amounts that you've taken. So you're essentially paying back the breaks that you've got, but it's not all bad because it's at 25%. So if your marginal rate is higher than that, you still make some money on the spread. Plus you have the advantage of you're getting the breaks in the past throughout history, and you're only paying for it now. So it's almost like a free loan in a sense.
Right.
So it's not.
But it's important for people to understand that, you're not going to be just taxed at your gain at your whatever capital gains tax is at. You're going to get also taxed at a rate of 25% on whatever the amount was you depreciated over the term of your hold. Right?
Yeah.
That's not in addition to, is it? It's an alternative. It's not like you get taxed both ways. You get taxed up to the depreciation amount, recapture at 25% and the rest at capital gains, or how does that work?
Yes, you got that.
Okay, got it. You guys follow that? So it's not like you're paying your full 300 grand of gain times your capital gains rate, and then you got to tack on 25% recapture of the depreciation tax rate on top. You take the depreciation recapture tax rate first, and then whatever's left over gets taxed at the capital gains rate. Is that right?
Yeah. So all it means is that your blended rate's not going to be 15%. It's going to be closer to 20 or 25 at the end of the day. And it's really helpful to just do a back of the napkin, calculation to figure out what this is going to be before you get serious about selling. A lot of the things that you said so far today are probably really surprising for most people because they're probably like, wow, the CPA is going to tell me how to do all this super aggressive tax stuff. But which we can certainly get to. But I'm really concerned with first and foremost protecting people. And I think that, if I just push the most aggressive tax things on earth, a lot of times it would either be too aggressive and attract an audit, or it would completely ignore all these other factors which are really important. One thing that I tell people sometimes, and their eyes really widen, is I say, why don't you just refi it and just cash out? Because if you're looking at a big gain, and you're going to pay at least 9% when you sell, between buyers, sellers, brokers, commissions, closing costs, 1.78%, basically sales tax in the state of Washington. And then whatever you have to fix it up for, and then, you've got a month or two of vacancy. So you're losing 10% at least just in selling usually, a normal 1 to 4 unit rental. So then I say, well, if you could borrow 75% of the value, you get to keep the asset, and it's a non-taxable event. So you don't even worry about capital gains. So there's sometimes when that makes sense, where you can get almost all the liquidity that you wanted.
People go, I'm tired of being a landlord. And then I say, well, then hire it out. I mean, you don't have to manage it yourself.
Yeah.
I don't know why people, I don't like property managers. Well, it's kind of like, geez, maybe you shouldn't be, people get so, I don't know, jaded on things, I think. We're so lucky to be in the positions to even be talking about the ability for us all to do this. Again, I'm cranky today, guys, so I don't want to hear your shit. Right?
It's funny. I feel like my whole job revolves around dealing with Cadillac problems, so that's okay.
Yeah, exactly. Exactly. So I'm going to just go back to it. We just broke it down how the 25% depreciation recapture is kind of the first hit, and then you get your capital gains tax beyond that, as opposed, I'm just going to circle it back up to what we were talking about with flip income getting taxed at your full, whatever tax bracket you're at. Plus, then on that one, you add on top, not blended, but add on top that self-employment tax, right?
Yes. And there's certain limitations within the self-employment tax. The lion's share of it is Social Security, and the other one is Medicare, Medicaid. It's the government health program. And the Social Security is the lion's share, and that phases out after your income is right around $128,000, I think, these days or so. And so if you're already really high income, your self-employment tax might only be about 3% rather than the 15%. I'm using really round numbers, and I have to apologize for that because I am in the car and a little distracted at the moment. But so that's kind of it in a nutshell. There's a lot of moving parts, but yeah, I mean, you could be hit really hard. You could be hit for 40% plus out the door on a flip, and if you made a ton of money, and if you could do it in a short period of time, and it's more money than you can make at a day job or with a buy and hold, power to you. Pay the tax and move on. But I think that people should know that when they're getting started with their strategy. You had mentioned kind of briefly about the gurus earlier, and I get kind of irked by gurus sometimes because I feel like they're very incentivized to talk about all the best things that can happen in like the top 1% of examples. And I feel like they don't always talk about the downfalls of things. And even tax gurus, to be frank, as well as financial gurus and different strategists. And so there are certainly some good ones out there, but I do get irked a little bit because, as you can tell by the way I'm talking, my goal is to first defend my people, and then secondly, try to annihilate their taxes to the best extent that we can. And I think that some people have that backwards. And I think that, I kind of owe them a certain amount of discipline in that. So that's just kind of, I don't know, maybe that's just me. And I know it might sound a little boring than what you were expecting.
No, I'm loving this stuff. I was telling Mark earlier that I was actually an accounting major, passed the CPA exam myself. It did take me a few tries, I'll be honest. I was almost ready to give up. That was not easy. So more power to all you CPAs out there that grind through that stuff. It was not easy. But, the point of the matter is, guys, is that everybody's situation is different. It's the same thing we've talked about before on what your borrowing situation is, which lane you are in as an investor based on your skill set, your borrowing power, your, whatever you can bring to the table. But sitting down, because your situations is going to change over time. That's why having a CPA on your team like Mark that is super investor friendly is. You guys hear that? My daughter.
Yeah.
You guys hear my daughter stole my phone and changed my ringtone. Listen. Ringing the phone. That's her singing. Yeah. That happens to me in important meetings such as this. It's a joy. But everybody's in a different situation, and you're going to need to check in over time as you make more money or you have changes in your family and all that stuff. I mean, your CPA is important as your doctor or, your attorney or as anybody else. And should be, when you're starting out, it's never too soon to just get a check-in of where you're at and have them help you with a little bit of some, tell you what your options are maybe on the paths that you can take and what happens when you hit certain thresholds. It's so valuable. It's actually more valuable, you guys, than learning how to flip a house. I promise you, because learning this stuff from somebody like Mark early on or listening to podcasts like this where we do deep dives on this stuff is you will find out later that you wish you would have known it from the start. So I'm trying to, I don't know why I feel like I want to sort of rearrange the starting gates for investors. I've been talking about that a lot lately and, just trying to touch on those things on these podcasts, and hopefully people will get what I'm talking about and ask more questions, but we'll keep moving on here. Let me ask you, with that in mind, you get investors, one thing investors are cheap, bunch of cheap asses. That's for sure. Right. I got it. You guys know it. It's amazing how many people will shop around to save $100 on a hard money loan fee. It's like, what? Come on, guys. But one thing that investors like to do, and I hear this all the time, is like, let me see how low I can get my tax bill. I've always been somebody who was like, oh my God, let me see how high I can keep my income, which probably isn't a smart necessarily approach to it either. But the reason why I do that is because I'm an investor. And I want to live my life and I want to be able to borrow money. And if I write off everything on the planet, then make up reasons to write off this and that and the partials this and, and then all of a sudden I find myself with a sweet deal in my lap and I can't borrow any money to make a killing. What do you think about that, Mark? Is there a balance?
Yeah, I think that's a trade-off that a lot of people don't think about. And it's not an A or B type question. There's a lot of middle ground there, because there are certain things about the presentation of your tax return that'll really hurt your ability to borrow. And there are other things you could do that'll reduce your reported income, but lenders typically add it back into there. And, this is actually a little more of a question for a lender, or like Albert Brewery's comments, who's on the podcast a little while ago. But there's a balance. I think a lot of people go into this not necessarily thinking about that. And if you've restricted your ability to borrow, you might have put a stranglehold on your business. And that's going to be really annoying when you come across a really good deal and all of a sudden you're having trouble borrowing, or you need to take on a partner and so forth, just because of a stupid thing like the way you presented something on your tax return.
And
so
when you
it's not just a matter of... Go ahead.
Are you talking about like using a Schedule C versus a Schedule E versus some other schedule, And
the way that you run through some personal expenses, people have like an office and all these other expenses, which they say, well, it's kind of related to my, it's related to my real estate business. Do I take it in here, or do I take it against my brokerage business? There's certainly, a lot of people don't like to admit this, but there's definitely some murkiness in there. And other things like depreciation, every lender knows how to add that back, but it's some of these other things that get a little weird. And it also kind of begs the question about using entities and how, and that's a whole bigger topic, mostly around asset protection, but it could also change your ability to borrow. Right.
Basically, guys, in a nutshell, check in with your CPA, because like we said, everybody's situation is different. Do you do the return for real estate agents who are not investors, just regular old agents? Do you do any of those?
Sometimes. I mean, for them, it's actually pretty simple. A lot of them are 1099, and then sometimes they'll set up an S corp to play that game in lowering the self-employment tax, like we kind of talked about earlier.
Yeah.
And then they tend to have a lot of unreimbursed expenses. So they have cell phone, internet, auto, meals and entertainment and things like that they're taking through. So it's kind of looking at what's the best way to capture all of that. If you're just a real estate broker and not investing in any other tax complications, that's kind of it in a nutshell for them. I mean, I could think of more if I give it some more thought, but it's not the most complicated thing when it comes to taxes.
Right. So it all comes back, guys, to maybe what we're picking up. If you're picking up what we're putting down, if you know what I mean, is that understanding when self-employment tax comes into play or not. Just Google it or look it up on Bigger Pockets or whatever. Read some articles about it and learn some more about what self-employment tax means, and because that seems to be the ugly, the rotten grape in the vine here. A little bit, and just knowing what that means and how it might apply to you now or in the future might be something for you guys to check up in on. So let's just say we do like writing off stuff. What do you think are the top 2 or 3 write-offs that give the biggest bang for the buck? That aside from maybe your home mortgage interest deduction or something like that.
Sure.
Does that question make any sense that I'm asking? Is there anything you can?
Yeah. It really depends on what kind of activities you're involved in. If you just work a day job and you haven't started investing or anything, it's really limited, especially since Congress's recent tax changes 6 months ago. It's really hard you can't really deduct miscellaneous expenses like you used to. If you have a rental business or you have a real estate brokerage business and so forth, or your own little business, even if it's not in an entity, if it's like a Schedule C, that gives you an opportunity to apply much more expenses against it. And so, people look at mileage, you juice depreciation, home office is very common. Some things, people spend a lot of time talking about meals and entertainment. I don't think that's a really big one, even if you're doing a ton of it. You no longer get to deduct entertainment, and you only deduct 50% of meals. So if your marginal tax rate is, let's say 1/3, right? About 32%. And you spend $100 on dinner, you only deduct $50 and you only take 1/3 of that. So you essentially get like $12 back from your $100 dinner. So it's really not the best medicine in the world. I don't know why people are talking about it so much.
Yeah. It's not, again, this gets down to like some nitty gritty stuff. It's, I get what you're saying there. I
can tell you,
there's a big one though, Mark. What about real estate education? What if you're a full-time investor or considered what would be the word they use for tax purposes for real estate? Isn't there I'm drawing a blank on it.
Education is a great write-off.
Yeah.
Whether it's seminars, books, any kind of thing like that, mileage and travel related to it. Where it gets a little sticky is if you go to, Hawaii for a real estate conference and really you're on the beach, technically you need to be spending over half the days doing a real estate activity. Your travel day might count if it's enough hours and enough time from door to door travel.
Basically, you got to be keeping a journal, it sounds like, to even if you got audited. But what about like if somebody spends $30,000 joining Fortune Builders or one of these things, can they write that off?
Yeah, so usually it really depends on how they're presenting their tax return, to be frank. But a lot of the times they can. And what I mean by that is I would say look into it before you join a certain program. Don't join the program and look at how you can write it off afterwards, because I would say most of the time you can, but there are a few times when you can't. So it's worth the question. Like I said, talk to a CPA, even if it's not me, I don't care. Within a few minutes, they could answer it based on, learning just a little bit more about your situation.
Right. How about, what about S Corps versus C Corps? I see most investors try to go the S Corp route, as we talked about, to avoid or minimize or whatever you want to say, the self-employment tax. I do see some investors that use a C Corp. What would be the reason for that?
When it comes to real estate, C Corps are bad news. And again, it's not 100% of the time, but it's a good 99% of the time. C Corps were favorable for real estate 30 or 40 years ago, and that has all changed since. So sometimes you see some of these partnerships on commercial buildings downtown and things like that. They're a C Corp only because they've been a C Corp forever and have never got around to changing. But aside from that, you don't want to use one for flipping. You don't want to use one for buy and hold. It's just bad news. It's a lot more expensive to maintain and administer. The tax rate is still not advantageous. You might have heard the buzz, of course, about a 21% corporate tax rate. That's when it earns money. When it gives you a distribution, it's taxed again at least 15%. So you're already at a minimum of 36% tax right out the door. So, I mean, it would be very rare to have a kind of scenario where that would be advantageous.
Oh, gotcha. We'll leave it at that. So how about the biggest impact on taxpayers in general? And if we can loop in real estate investors in specific, related to the new tax laws that just went into effect? What's the biggest impact? Or is it a benefit or is it a negative?
I think it's a net win for real estate investors for sure. As you probably know, our rates went down. Most people across the board are getting some money back. And as it relates to real estate investing, you could, like I said, your improvements, bonus depreciation has been a pretty hot topic when you're doing any kind of an improvement, or even if you're buying real estate assets that have a shorter useful life, which is not going to be apartments or commercial property, but people who buy things like gas stations, believe it or not, they can write off the entire gas station in the year that they buy it. That is a really big deal instead of depreciating it over 20 or so years. And I know that's kind of a weird nuanced thing. Another thing that happened
is there anything with mobile homes is that just considered just like another straight up rental type of situation like multifamily?
That's a good question. With mobile home parks, of course, a big part of it is the land, but a lot of it's actually land improvements. And land improvements have a shorter useful life as well. So there's a lot of opportunity on that as well. And it's gotten better. Another big thing that's happened in the blog world, this has been all over the place, of course, is that most people are losing their benefit from itemizing deductions. So they're losing a tax benefit from their primary home. And that's basically because the standard deductions increase so much. And so the way it pencils out is if you buy a new home and it's $800,000 or less, and you write off your interest in your property taxes, you're probably still below $24,000, which is your standard deduction if you're married anyways. And so if you buy $1 million home, it'll probably be a little bit over $24,000, but not that much. So it's certainly not a reason to buy a house. So kind of the answer behind that is with leverage, it makes a lot more sense now more than ever to leverage your investments rather than your primary home, because you can write off the interest on your investments still. And then the other benefit that you get is from an asset protection standpoint. And I'm not a lawyer, but you have less equity in these rental properties. So now different things like that look a lot more advantageous to push whatever of those expenses you can do legitimately to your real estate business rather than trying to take it on a Schedule A. Does that make sense?
Yeah, that makes sense. Yeah. Wow. Yeah, just another reason to own rental properties. I think it's all interesting. I'd like to do a Seattle Investors Club meeting where we almost draw this big mind map, almost like this. I don't know if it's possible, but if this is the ideal path. If you were to set yourself up with this ideal path, and everybody's going to have different reasons on what's ideal, but making some assumptions, and then show people kind of a roadmap to get there, that'd be something cool. I don't know if that's doable because everything is individually specific, but it's all fascinating to me. Every time I do one of these podcasts talking about, tax stuff or debt and things like that, I almost get lost up here in my own head. I can't even barely focus because I think it's such great information and so informative, and there's so much to learn, that I hope that people who are out learning how to be real estate investors are spending, putting quality time and time blocking aside some time to learn about these topics, debt and leverage, your personal borrowing situation, meeting with a CPA, learning about S corps and self-employment tax, and bonus depreciation and, all these things. These are, if you're just a person who's going to do investing here or there, maybe you can just, you don't need to get all deep dive on this, but I think it's fascinating. I think lots of people who are investors actually are just as big as the geeks as we are, Mark, and they love learning about this stuff as much as they love learning. In fact, people after a while start loving the strategies and how to make their money through smart strategies with tax and planning and asset protection versus just swinging a hammer and doing a house hack or a flip, right? It's kind of the, almost more educated or, way of making your money. I don't know. Again, I'm not saying it PC correctly, but you guys get what I'm saying. Don't forget the geeky stuff, and when you guys are thinking about how to grow your business, you might be able to do nothing and just change the way you hold things or the way things show up on your tax return. And you might make some money just doing that, right? If you learn about your situation. I guess that's my point. So, let's see. Is there anything else we want to wrap up here? I think that's probably it, because you're probably coming to the end of your ferry ride. And I just got the silent get off the phone. I need to take you to go get your car that's in the shop signal from my crew here. So that sounds like a good time to wrap up here. Mark, anything else you want to add? And man, it's been awesome. I've thoroughly enjoyed, you're very straightforward, level-headed, obviously very smart and passionate guy with a wonderful glow. So,
you guys.
So we want to do more with you. We're going to get you to an SIC meeting and have you maybe present something to the crowd, especially as we're getting here towards the end of the year and people are more excited to stay awake to talk about their tax situation and learn about what's going to happen and impact them here towards the end of the year. Does that sound something you'd be interested in?
Yeah, sure. I think that, this has been just barely the tip of the iceberg today. And of course, we can get into, strategies that are, a little bit more on the aggressive side. Like I said, I like to first start with the big picture because, real estate investing has to be a team sport. And you have to look at it. You can't make these decisions in a vacuum. You have to look at how it's going to affect all these different parts. And that was kind of the gist of my message today. And I'm sure everybody's kind of wondering, okay, well, now what? Now what about those strategies to be aggressive? And that's something we could cover in a later meeting if you like.
Yeah, for sure. Let's do it. Sounds good to me. Well, I'm going to turn it back over to Joe, who's going to tell all you guys how you can get the awesome information. Actually, Mark, if people want to engage you from additional help and guidance and review of their personal situation, how can they reach you? Is there a way that you'd like to send them to a website or your contact information?
Sure. Yeah. So if anyone would like to reach out to me, my name's Mark Canton, Canton. My firm is called Hunt Jackson CPAs. I'm one of two partners. That's Hunt as in going hunting, Jackson as in Andrew Jackson CPAs. Our phone number is 206-932-1314. And, if you don't know if you need a CPA and you're just kind of saying, well, is it complicated? Is it not? Just give me a call. I'm happy to have a quick chat. And to be frank, there's a lot of people that I kind of send away saying, here's a little bit of info. I think you could probably figure this out yourself on TurboTax. I'm really not in the business of pushing sales on people, but usually knowing your gut when it's complicated enough that it's time to talk to an expert. So if you're out there, feel free to reach out to me, and best of luck to everybody.
Awesome. Joe, where can they find all these awesome show notes?
Heck yeah. So everybody, thanks for listening. You can find the show notes at seattleinvestorsclub.com/43. That's seattleinvestorsclub.com/43. We'll have all the questions and show notes in that location. And remember that we love iTunes reviews. So if you love this podcast, you can head over to seattleinvestorsclub.com/iTunes and give us a review, because every 5-star review we get helps us to get this message of real estate investing out there to more people.
And it helps us get more killer guests on our podcast. So Let's keep growing this thing together, guys. We need your help. Give us a review.
Heck yeah. Good stuff.
Right on. All right. That's about it. I'm going to go get my car that's in the shop. And then I'm actually going to an appointment for us, Joe. How do you think about that? There you go.
Awesome. I'm going to get some more of our podcast pushed out. So high five.
Right. Mark, thanks again. And we'll see you in a few.
My pleasure. Take care.
Thanks for listening to the Seattle Investors Club podcast. If you have questions that you'd like to have answered on the show, shoot us an email at info@seattleinvestorsclub.com. Now go out, take that action, and build that real estate business. Thanks for listening.